Hello friends, in this lecture we will take up the recognition and subsequent measurement principles relating to biological assets which are contained in IND AS 41, IS 41. So we will continue with agriculture. So in this lecture we will discuss about the recognition principles, subsequent measurement principles relating to biological assets which are contained in IND AS 41. So let us go ahead with it. Now, initial recognition of biological assets or produce. So the first question is, when can I recognize biological assets in my books of account? When can I recognize agricultural produce in my books of account? The standard gives the answer. It says, first of all, you have to demonstrate control, that you have control over the biological assets. Control is normally demonstrable by way of legal rights. Okay. Second, you have to demonstrate the fact that it is going to generate you future economic benefits. Okay. And the third thing is, you should be either able to measure the fair value of the biological asset or the agricultural produce or the cost. Okay. So when these 3 points are satisfied, you can recognize biological asset or produce in your books of accounts. So one is control, second is probable future economic benefits, and third is either the fair value or cost should be measurable. So when these 3 points are satisfied, you can recognize biological assets in your books of accounts. Okay. Now, control is normally by way of legal rights. Suppose you are having cattle, so you have to demonstrate that you have legal ownership of cattle. We put our marks on the cattle when they are born or when they are weaning, etc. Okay. Next. Now, as per the standard, biological assets should be always be recognized initially in our books of account at fair value less cost to sell. Even subsequently, these biological assets have to be measured at fair value less cost to sell. So normally there is a reputable presumption that at initial recognition we will be able to determine the fair value of the biological asset less cost to sell, and even subsequently till the date of sale of the asset we can measure the fair value of the biological asset and its cost to sell. Okay. Only in certain circumstances, when you are not able to measure the fair value of the biological asset, fair value less cost to sell for the biological asset at initial recognition, in such cases you can adopt the cost model. Only in such circumstance you can go away from the fair value model, or else the standard says at initial recognition the biological asset, harvest, agricultural produce has to be measured at fair value less cost to sell. Even subsequently it has to be measured at fair value less cost to sell. Okay. So a biological asset shall be measured on initial recognition or at the end of each reporting period at its fair value less cost to sell. Agricultural produce harvested from an entity's biological assets shall also be measured at fair value less cost to sell at the point of harvest. So at initial recognition, same principle. Agricultural produce, harvest, same principle. Okay. Such measurement is cost at the date when applying IND AS to inventories or another applicable standard. In our earlier lectures also we discussed, when you extract latex from the rubber tree, the stock of latex is measured at fair value less cost to sell. This will become cost for future. That means when latex is used as raw material for manufacture of rubber, the fair value less cost to sell for latex, which was decided at the point of extraction, that will become cost of raw material which is consumed for production of rubber. Okay. So if you have picked apple fruit from apple tree, you have to estimate what is the fair value less cost to sell of that picked fruit, and in future when this apple is used for manufacturing a finished product, the raw material for that finished product will be apple, cost will be equal to what you have decided at the point of harvest. Okay. Now, what is meaning of fair value? Fair value has to be determined based on requirements of IND AS 113. This definition we have seen again and again. It is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So we can say roughly it is the price at which market participants would be ready to exchange the assets for. Okay. Cost to sell are the incremental costs directly attributable to disposal of an asset. We can say transportation costs, some brokerage, commission, etc. But it should exclude finance costs and income taxes. So we are not going to include finance costs, interest and income tax as part of cost to sell. The cost which you have to incur to get the biological assets sold, only those costs have to be subtracted to arrive at fair value less cost to sell. Okay. Next, how to estimate fair value? The standard says, first of all, go to the market, try to find out which attributes are used by the market participants to arrive at the market price for the biological asset. Let us say the market participants use certain attributes like age of the biological asset, quality of the biological asset, weight of the biological asset. In such cases, based on these attributes, the entity should also group its biological assets, and based on these physical attributes, we have to arrive at the fair value of the asset, and these attributes are used to decide price in the market. Based on those attributes, you also classify your biological assets and then estimate the fair value of the asset. This is what the standard has to say. Example, a dairy farm may group buffaloes or cows into calf, heifer, milking animal. So when a cow gives birth to a calf, when a cow gives birth, the cow is called as a calf, and after a year it is called as a heifer. And milking animal, once the cow gives birth to a calf, it starts giving milk, we call it as a milking animal. So the market will have a different price for a calf, for a heifer and milking animal. So if you have a stock of biological assets, you will classify them into calves, heifers and milking animals, and based on that you will arrive at the fair value of the biological asset, subtract the cost to sell to arrive at the value which has to be shown in the books of accounts. Okay. Next, contract prices, should they be considered? See, many times farmers may enter into contracts to sell their produce in the future. So they are having some biological assets, but they would enter into contract to sell these biological assets in the future based under a contract price. But what the standard says is, we are going to ignore that contract price. What is the current fair value? If I sell it in the market today, what am I going to get? So that has to be given more importance than the contract price. Sometimes these contracts can give rise to onerous contracts. When will they give rise to onerous contract? When the cost is going to be more than what you are going to get, when you sell it. In such cases, such contracts can become onerous contracts. Or there can be another situation where you have contracted to sell milk at say 40 rupees per litre. You have already contracted, but in the market you could have sold it for 45 rupees or 50 rupees. In such cases, such contracts can become onerous. Or we can say when the cost of fulfilling the contract is more than the estimated benefit under the contract, then such contracts can become onerous contracts. So we would have to provide for it, which is dealt by IND AS 37, not by the standard. Okay. So what we want to know here is, even though you have a contract to sell the biological assets in the future at a price, you are not going to consider that contract price, but we are going to consider the current market prices for the purpose of arriving at fair value. Okay. Next, what should not be considered? Finance cost, interest cost cannot be considered for arriving at fair value. Taxes, cost of replanting after harvest. You have harvested your wheat crop. So the cost of replanting that crop, you are not going to consider for arriving at the fair value of the crop. Okay. Next, sometimes cost may also approximate to fair value. There can be situations where you would have to use cost as approximations of fair value. The two situations are, little biological transformation has taken place since initial cost incurrence. You have recently planted, we can say some plants just before the balance sheet date. So there would not be much of a biological transformation which would have taken place, and there would not be much of an increase. So in such case, we would take the cost as measurement of the fair value. Okay. And the other situation is the impact of biological transformation on price is not expected to be material. Suppose you have planted a pine plantation which has a 30-year life cycle. So you have initially planted, this year you have planted the pine trees, and by the end of the year the pine trees would have grown, but the growth is very, very negligible. In such cases, whatever was the cost of plantation, that we can consider as fair value. Okay, because the growth which is happening initially is of very low fair value, it is negligible, but as years pass by, maybe after 5 years, 10 years, then the fair value will become material. In such cases, we will not use cost, we will consider the fair value of those pine trees for the purpose of recognition in our balance sheet. There will be some gains as well. Okay. Now, sometimes fair value is available as a package. We are talking about plantation forests. What's a plantation forest? Sometimes in developed countries, we can say, to meet their requirement of wood, lumber, what companies do is, they do afforestation. That means they will clear the land wherever they find some land, they will do some land improvements and then do forestation, and they will leave it for a few years, and they will keep looking after it, they will do watering, etc. And after some time they are going to cut those trees for meeting their wood requirements. That is called as a plantation forest. Now, if you want to arrive at the fair value of the trees which are there in the plantation forest, you may not be able to estimate fair value only for those trees. So if you go to the market, you may get a fair value for the entire plantation, including land, including improvement and the plant value. That means you will get the fair value for the package. So if you want to arrive at the fair value of the plants, then in such case you would have to subtract from the full package fair value, subtract the fair value of land, land improvements, then you will automatically arrive at the fair value of the trees which are standing in the plantation forest. Okay. Next, gains or losses in P&L account. When I recognize biological assets initially, I have to measure it at fair value less cost to sell. It will become a gain for me. Let us say a calf is born. Let us say there is a dairy farm, they are looking after cattle. The cattle has given birth to calves. Now this calf has to be recognized as a biological asset in my books, and when I recognize it initially in my books at fair value less cost to sell, it results in a gain for me. Okay. Now I have extracted milk from the cows, that is called as agricultural produce or harvest. I have picked fruit from the trees. I have picked fruit from the palm trees. This agricultural produce or harvest is again gain for me. Okay. So I am going to measure them at fair value less cost to sell, and their value will become gain for me. I am going to recognize them as a gain. Okay. In future, when I sell this, whatever was the, say I will pass an entry, picked fruit, or I will say stock account that are to fair value gain account. The fair value less cost to sell of the picked fruit, I will say stock of apple account that are to fair value gain account. This fair value gain will go to P&L account. When this apple is sold, the stock will become cost of goods sold and related turnover will be recognized. So that is how I can pass entry. I can pass stock of apples account that are to fair value gain account when I pick the fruits from the tree, and then when I sell the apple, I'll get cash account that are to sales, the amount for turnover, and stock will be debited to P&L account in the form of cost of goods sold. We'll say P&L account or to cost of goods sold or P&L account or to cost of sales. So that is how I account for it. Okay. And third situation is a gain arises when agricultural produce is recorded in the book as a result of harvesting. A gain or loss arises when fair value less cost to sell changes for a biological asset. See, there can be three situations. When I recognize biological assets initially, there can be a gain. When I measure the agricultural produce or harvest, there can be a gain. The third situation is there can be change in the physical characteristics of the biological assets. Let us say I had some cattle at the beginning of the year. I would have recognized them in my balance sheet at a particular fair value. By the end of the year, the fair value of that cattle might increase. So that difference is again becomes a gain for me. Or sometimes the cattle has become old, the fair value may reduce when compared to the fair value at the beginning of the year. It will be a loss, it will be debited to profit and loss account. So we can get three types of gains at initial recognition, on harvest, that is when you produce agricultural produce, and third is on subsequent measurement of biological assets. So any differences would be transferred to profit and loss account. Okay. Now, a loss sometimes may arise on initial recognition of a biological asset because cost to sell are deducted in determining fair value less cost to sell of a biological asset. It's a very simple point to understand. When I buy a biological asset, normally the rule is I will be buying them at fair value. But can I recognize them at purchase cost? The answer is no. The standard says initially recognized at fair value less cost to sell. When I purchase, I pay the fair value and I purchase it. But when I have to recognize it in my books of account, I have to recognize it at fair value less cost to sell. Let us say 100 rupees was the cost price. But when I consider the cost to sell, 100 is the fair value, let's say the cost to sell is 10. Even though I have paid 100 rupees for buying that biological asset, I have to show it at only 90 rupees. That means I have incurred a cost of 100, but I have to show it at a value of 90. Automatically there can be a loss. So because of cost to sell, sometimes at initial recognition you may get a loss because of a biological asset. You pay 100 to buy it, but when you consider the cost to sell, the fair value less cost to sell may fall below the cost and it may result in a loss. Okay, so you may pass an entry, biological asset account or to cash 100, but this biological asset has to be restated at 90 because you have to show it at fair value less cost to sell. In such case, we will say loss, fair value loss account net to biological asset 10 rupees. That means the value of the asset has to be reduced by 10 rupees. So there can be a loss because of cost to sell. Next, exception to fair value rule. There can be a situation where we go against the fair value rule. So there is a presumption that fair value can be measured reliably for a biological asset, but this presumption can be refuted only on initial recognition. So at initial recognition, the presumption that the fair value of a biological asset can be measured reliably can be refuted. That means you have to demonstrate the fact that there is no active market for the biological asset, or quoted market prices are not available. You are not able to get the market prices for this biological asset at initial recognition, or there are no other alternative ways, reliable ways of estimating the fair value. In such cases, you can rebut the presumption that the fair value of a biological asset can be estimated initially. In such cases, you can adopt the cost model. That means you have demonstrated the fact that you don't have an active market, or it is not possible through other ways to arrive at the fair value. In such cases, you can rebut the presumption and you can follow the cost model. When you follow the cost model, you are going to show the biological asset at cost less accumulated depreciation and accumulated impairment losses. But this, you can rebut the presumption only at initial recognition, but continuously you have to try to arrive at the fair value subsequently. So suppose at initial recognition you are not able to arrive at fair value, you can adopt the cost model. But subsequently, if it is possible to estimate the fair value of the biological asset, you have to arrive at the fair value of the biological asset, and if there are any changes in value, it has to be recognized in profit and loss account. Okay. So in such a case, that biological asset should be measured at its cost less accumulated depreciation and accumulated impairment losses. So you can adopt cost model. Only at initial recognition, this assumption is possible that fair value cannot be measured reliably. You can adopt the cost model. After initial recognition, the standard clearly says if you are getting some harvest or if you are getting some agricultural produce, the standard says you definitely have to arrive at the fair value less cost to sell. There is no possibility that you can say, there is no possibility of saying that fair value cannot be measured reliably. That means for agricultural produce, for harvest, the standard does not recognize a situation where fair value cannot be measured reliably. That means agricultural produce, harvest at any point, at any cost has to be measured at fair value less cost to sell. But biological assets at initial recognition, if you can demonstrate certain facts, in such cases you can say that the fair value of the asset cannot be measured reliably, you can adopt the cost model. Okay. But again, you have to continuously check whether the fair value can be determined reliably, and if you say yes, fair value can be determined reliably, you have to start measuring the asset at fair value only. Okay. Now, once the fair value of such biological assets becomes reliably measurable, an entity shall measure it at fair value less cost to sell. Once that means the company has to keep that biological asset under constant review, and once they find that fair value can be measured reliably, they have to change from cost model to fair value model. Okay. Once a non-current biological assets meet the criteria to be classified as held for sale or is included in a disposal group that is classified as held for sale, IND AS 105 will apply. Then in such cases, you cannot argue that fair value cannot be determined. That means, suppose you have decided to sell away your dairy division and you have decided to sell away the cattle along with the division. In such cases, this cattle forms part of a group of asset which is considered as asset held for sale under IND AS 105. Once it is considered as asset held for sale under IND AS 105, you have to estimate the fair value. You cannot state the fact that fair value cannot be estimated reliably. You would have to measure in such case that cattle at fair value less cost to sell only. Okay. So this we can say you can rebut the presumption about fair value less cost to sell only at initial recognition, not in other circumstances. In the case of agricultural produce, harvest, the standard does not allow such rebuttal of the presumption. Definitely you have to measure them at fair value less cost to sell only. And in the case of assets which are classified as held for sale, again there is no possibility, you have to measure them at fair value less cost to sell only. Okay. Now fair value other points, an entity that has previously measured a biological asset at its fair value less cost to sell continues to measure the biological asset at its fair value less cost to sell until disposal. So at any point of time during the life of that biological asset, if you have arrived at the fair value, then till disposal you have to measure it at fair value only. There is no possibility to go back. This standard reflects the view that fair value of agricultural produce at the point of harvest can always be measured reliably. So this is what we have been stressing again and again. At the point of harvest, agricultural produce can always be measured at fair value, and the standard does not allow us to use cost model for measuring the harvest or agricultural produce. In determining the cost, accumulated depreciation, accumulated impairment losses, an entity considers IND AS 2, IND AS 16, IND AS 36. So this point is relevant only for those biological assets where we were not able to measure the fair value and we were measuring them under the cost model. In such cases, we can take the help of these standards for the purpose of arriving at the meaning of what is cost, what is depreciation, what is accumulated impairment losses. Okay. Next, government grants. In certain situations, agricultural, we can say the companies that are engaged in agricultural activities, they may get some government grants. government grants received for not engaging in agricultural activity should be recognized in P&L account when conditions are met. Sometimes the government says you please don't get involved in certain agricultural activity. In such cases, you can recognize this government grant in P&L account only when you have satisfied the conditions imposed by the government. Sometimes the government may say that you have to compulsorily do agricultural activity in a particular location for a particular period of time. Again, when you have satisfied the conditions, then you can recognize government grant. Suppose the government says you have to do particular farming in a particular area for 5 years. In such cases, once you complete those 5 years, then you can recognize the government grant as income in your P&L account. And suppose government says, boss, we are giving you $100 million. You do farming for 5 years. And say if you have done farming for 2 years, then we will allow you to keep 40% of the government grant. Sometimes there may be a situation where you can recognize a portion of the government grant as income even though you are not able to satisfy the entire condition. Okay. Then government grants for biological assets measured at fair value less cost to sell should be recognized in P&L account whenever they become receivable. So when you are receiving government grant for a biological asset which is measured at fair value less cost to sell, in such cases once the government grant becomes receivable, you have to immediately recognize the entire government grant in P&L account, which is little different from government grants related to depreciable assets, okay, where we follow the deferred income approach. We recognize government grant as deferred income in the proportion of depreciation charged. But in the case of biological assets which are measured at fair value less cost to sell, if you receive any government grant, it can be immediately recognized in the P&L account as soon as it becomes receivable. It will become receivable once you have satisfied the conditions for receiving that government grant. Then government grants relating to biological assets carried at cost less depreciation shall be dealt as per IND AS 20 government grant. So if you have received any government grant for bearer plants, or if you have received a government grant for an asset whose fair value could not be measured reliably at initial recognition, in such cases for such assets which are being shown in our books of accounts at cost using the cost model, for such biological assets where we are following the cost model, in such cases the government grant should be dealt as per IND AS 20. That means you have to use the deferred income approach. You cannot immediately recognize in the P&L account. You will credit it to equity and a portion of government grant will be amortized to P&L account in the proportion of depreciation charged on that biological asset. Okay. Now before I stop this lecture, I will summarize the points. At initial recognition, the biological asset has to be measured at fair value less cost to sell. It can become a gain. You can simply pass an entry biological asset account or to fair value gain account. When you pick fruits from the tree, when you get produce from your agricultural activity, again you will say agricultural produce account or to fair value gain account will be credited to P&L account. When this agricultural produce is sold, you will say P&L account or to agricultural produce. That means the carrying amount of the agricultural produce will become cost now and related revenue will be credited to P&L account. And you had some biological assets at the beginning of the year. By the end of the year, the value of the biological asset has increased. Suppose at the beginning of the year, the value of the biological asset in your books was 100. Suppose you have a herd of buffaloes, or you have a herd of sheep, or you have a herd of goat. So fair value at the beginning of the year might be less, but by the end of the year, if the fair value increases, the difference has to be recognized in a P&L account. You will pass the entry biological asset account or to fair value gain account. This fair value gain will be credited to P&L account. Okay. So this is what we had to discuss in this lecture. Thanks a lot.